Hello everyone. Thanks for joining us again as we learn more about the basics of investing and how to invest wisely. This is a big topic, and to keep the videos relatively short, I've broken it up into 3 segments. This is part 2. In part 1, we spoke about why we invest, about the power of compounding interest and the relationship between risk and reward. In this video, we're going to discuss the most common investment choices: stocks, bonds, or cash. So here we go. Most of us are familiar with most of the terms on this slide and realize that these are some of the common options where people put their investment dollars. You may even own some of them yourself. But in my personal past experience, as well as through conversations with many others, I realized that a lot of us recognize the names, but maybe don't really understand what each of these things are, how they're similar, how they're different, and what to expect from each asset class when we choose to add them to our investment portfolios. For this lecture, I'm going to focus on the first 3: stocks, bonds, and cash equivalents. Let's start with stocks. Everyone has heard of them, and most of us own some. But what are they exactly? Well, a stock is essentially a small piece of a company. When you buy a stock, you become a part owner of that company. That's pretty cool, right? The even better news is that you don't really have to work within the company or even understand what the company does to be an owner. As a common stock owner, you're simply giving the company some of your money so that the company can use it to become more successful. If your money is used wisely and the company makes a profit or grows its assets, your little piece of that company grows in value. You can then sell that piece to someone else and cash out the difference. Also, if the company is profitable, sometimes the board of directors makes a decision to share some of those profits with all the owners or stockholders in the form of a dividend, which is just a share of the profits. That doesn't affect your stock value directly, but it's more like getting a bonus at work. So that is the upside of owning a stock. The downside is that if the company does poorly, then the value of your stock will go down and you could lose money on that investment. Owners are always the last to get paid. In the worst case scenario where the company goes bankrupt, you could lose everything. All the other creditors are ahead of you in line, and you only get your share of what's left over, if anything. So, when buying stocks, you really should be thinking about buying companies. Is this a company that you trust to make good decisions with your investment? Is this a company that you expect to grow, to be profitable, and to be around in 10 years? If not, it's probably not the smartest investment. It's also important when buying anything that you don't pay more for it than what you think it's worth. You wouldn't do that at a grocery store or at a car dealership, right? Not unless you're desperate. Well, you should never be desperate when buying stocks. Be sure that the price of the stock meets or is less than what you perceive as the value of the company. There are many ways to value a stock, and that goes beyond the purpose of this lecture. It's also not an exact science, and there's lots of disagreement among very smart people. But that's what creates a market, right? Some people buy because they think the stock is undervalued, while others sell because they think the same stock is overpriced. The point is, do your research. If you focus on buying good companies at reasonable prices, chances are that you will do well in the long run. This also underscores the importance of diversification. None of us will get this calculation right all the time, or maybe even a majority of the time. But the more companies you have in your portfolio, there's a great likelihood that some of those companies will do really well and will likely more than make up for all those that do poorly. When looking at companies, there are many terms that you may have heard of. This gets down to the style of investing. Let's start with growth versus value. What does that mean? A growth stock is one from a company that you expect to grow over time. Is typically on the smaller side or new in an industry or maybe a market leader, but in a growing industry. If you buy the stock when the company is still relatively small and the company grows a lot, then the worth of your stock can grow exponentially. But the reality is most companies don't grow rapidly or continue to grow in the long term. So growth stocks are considered more risky. They're also typically more expensive because investors are pricing in the future growth into today's prices. That adds to the risk. You're buying it when it's already expensive, but hoping that it grows faster than the market predicted. On the other side, a value stock is one that you think is underpriced, so you're buying it at a bargain. These are more likely to be established companies whose stock prices don't fluctuate as much as growth stocks, but the cycles of the market in general presents buying opportunities. If the market is in a downturn, for example, for something unrelated to the performance of the company that you're considering. The danger of value investing is that maybe the reason the stock seems cheap is that the company is actually weak or losing market share to competitors, or has leadership issues, or a myriad of other problems. So you need to do your research to be sure that the company's fundamentals are sound. If so, value investing can be a great way to make money in the stock market. It's how Warren Buffett does it. Another consideration is the size of the company that you're buying. This is called the market capitalization, or market cap. Large cap stocks are from companies whose market value, defined by the number of shares out there times the value of each share, is larger than $10 billion. A small cap stock are companies whose market value is less than $2 billion. And mid cap stocks are everything in between. In general, large companies tend to be more stable and less risky. They've proven to be successful already. The question is if they can maintain this success and grow even larger. Small cap stocks are more risky because the companies are typically newer and still trying to establish themselves in their respective markets. They have great potential for growth. Remember, all large caps are once small caps, but also a high likelihood of failing or being acquired by a larger fish. Mid caps are somewhere in between in terms of risk and growth potential. Another strategy to consider is sector investing. A sector is the type of industry that the company works in. It might be information technology or communications or consumer goods or utilities. Each sector performs differently in different economic conditions. Most people try to get a mix of each of the main sectors to further diversify risk, but some investors are heavily weighted to a particular sector that they understand the best. So how do I buy a stock? Well, there are two ways. One is directly from the company in what is called an initial public offering. This is where the company sells the stock directly to investors and gets cash in return. Most of us don't have the opportunity to buy stocks in this manner. These are offered to institutional investors primarily. But then those investors put the stocks up for sale afterwards on the secondary market, and that is where we can buy them. Those markets are probably familiar to you. The most famous is the New York Stock Exchange. The other major market is called the NASDAQ. When you buy and sell stocks on an app or through your broker, they are buying or selling them for you on these secondary markets. The prices go up and down constantly and is the fodder for all the stock tickers and the financial news stations to give opinions about what's going to happen to the market on any given day or moment. So what is a brokerage? These are companies that take your orders and then execute those orders on the market, looking for buyers or sellers for you to make your trade. They used to charge a lot of money for every trade that they made on your behalf, but with the advent of the internet and online trading, the prices of brokerages have dropped dramatically. In fact, the largest discount brokerages like Schwab, Fidelity, and Vanguard now allow you to make trades on their platform for free. This has given rise to the DIY investor or retail investor, people like you and me going on these sites and buying and selling our own stocks. It's a great time to be an investor. You used to have to pay a stockbroker to make those trades for you, but now you can do it yourself. But this comes with the downside. If you're a DIY investor, there's no one else to blame if you mess it up and lose all your money. So be wise. If you don't have the interest or capacity to do the research that you need to make a good decision, it's best to leave it up to professionals or invest in passive index funds. More on that later. Okay, switching gears. Bonds. What are bonds? Unlike with stocks, when you invest in bonds, you do not become an owner of the company. Instead, you're more like a bank. You lend money to the company with a contract that says that the company will pay you back what you lent them after a given amount of time, usually many years, and will pay you interest along the way. Everything with a bond is decided ahead of time. You will lend a defined amount of money at a defined interest rate, usually paid every 6 months, for a defined term. At the end of that term, you get your entire investment back dollar for dollar. So, the main consideration of bond investing is the financial strength of whoever it is you're lending the money to. If they go bankrupt and can't pay their bills, then you lose your investment. The glimmer of hope in that situation is that there will be enough left over in a liquidation event that you'll get some back. Remember, you are in front of the company owners or stockholders in a liquidation scenario. Governments typically borrow money by issuing bonds. So how stable is the government you're investing in? Large governments like the US are unlikely to default on their loans. Smaller governments have a much higher risk. Same with companies. Some are more stable than others. There are agencies that rate these governments or companies in terms of risk. Standard & Poor's and Moody's are examples. They give a letter grade to these borrowers. A AAA rating is the best. It goes down from there, AA, single A, triple B, double B, etc. The farther away from AAA, the more risky the investment. And if the risk is higher, the companies have to pay a higher interest rate to incentivize investors to loan them money. So typically, US government bonds and AAA rated company bonds pay less interest than companies or governments with lower ratings. This leads to the term high yield bond or a junk bond. Yield means interest rate. So a high yield bond is a bond with a higher interest rate. It's higher because it's riskier and coming from companies that are less stable, which is why it's also called a junk bond. Another consideration with bonds is the duration of the bond term. If you buy a bond for 1 year, there's much less chance that a higher rated company would go bankrupt in that short of a period. So your bond is pretty safe and your expected interest rate will be lower. If you buy a bond for 30 years, however, a lot could happen to a company during that time frame, and you should demand a higher interest rate to take on that risk. Anyway, like stocks, bonds can be sold on the secondary market after they're issued. The prices of a used bond fluctuate depending on what options investors have to replace them with a new bond bought directly from the company or the government. If you could get a bond now that is paying a higher interest rate, all else being equal, to the one that you're currently holding, the older bond loses value because it's paying less interest. So interest rates and bond prices are inversely related. That's why bond prices have dropped in the recent high interest rate environment. This price fluctuation is only a risk if you're buying and selling bonds on the secondary market, rather than directly holding the bond for its duration. If you hold the bond, you get what you're promised, all your money back, and the interest paid in the interim. Okay, moving along. Let's talk about cash. So one strategy to save for your future is to pocket all that cash and sit on it. You might put it under your mattress. You might park it in a savings account. If you do that, you're very unlikely to lose your money, home robberies and house fires aside. But your money will not grow in value either. Your money is not making money. It's just sitting there. But what about the interest in my savings account, you might ask? Well, when's the last time you checked how much your bank usually pays you in interest on money in a regular checking or savings account? It's typically hardly anything, less than 1%. The average inflation rate is between 2.5 and 3%. So your money is losing value against inflation. You'll be able to buy much less in the future with that same amount of money. There are other cash-like investments that do a little better in terms of interest. For example, currently there are high-yield savings accounts that in 2024, in this high interest rate environment, are paying over 5% in interest per year. That's really good, but that's not normal and will be unlikely to stay that high. You could invest in a certificate of deposit or a CD through a bank. This will pay you a little bit higher interest rate, but requires that you commit to let them use your money for a given period of time, maybe a year or two, for example. If you take your money out before then, you pay a penalty. A money market fund is an investment account that invests primarily in these safe investments through banks. They can give similar interest rates to a high-yield savings account, but don't have the same government protection as banks. Another safe investment is a short-term government bond called a treasury bill. This is considered a risk-free investment because it's backed by the tax authority of the US government, which basically means that the US government will not default on its loans because it can always raise money by raising taxes on its citizens. So in the long run, investing in cash or cash equivalents is more than likely going to decrease the real value of your net worth because it's growing slower than inflation. That being said, there are reasons to have a portion of your portfolio invested in cash. I mentioned before that there's a little reasonable chance that you will lose this money if it's in a protected U.S. bank or credit union. The government insures that money to a given amount, currently $250,000. On the other hand, investing in stocks or bonds could cause wide fluctuations in the value of that investment, and there are times where you could lose money on them. So if you're going to need that money within the next few years, it makes more sense to keep it in cash and not risk a loss without the time to let it recover. This includes maintaining an emergency fund that is easily accessible and doesn't require that you sell anything to get the money. We talked about that in previous lectures. So plan ahead, budget what you'll need, keep that in cash, invest the rest. To further clarify that point, there are some important questions that you should ask each time you make a decision about what you're going to do with your investment dollars. When do you need the money? Do you need income from your investment? How risk averse are you? Stocks historically give the best return on investment over the long term with lots of ups and downs along the way. If you're super risk averse, those ups and downs are going to keep you awake at night. Maybe stocks aren't right for you. But if you can remember that stock investing is for the long term, then you're likely to make the most from this type of investing. Bonds are important for those people who need a fixed amount of income from their investments, like if you're retired, for example. The income in the form of interest on the bonds is predictable. The ups and downs of bond prices on the secondary market are usually less dramatic than stocks. So for investors who can't afford as much risk or want steady income, bonds are the way to go. Cash is for those who are super risk averse and cannot stomach losing any money on investments, or more practically, those who will need that money within a shorter period of time, like less than 5 years. Remember that cash investments are almost guaranteed to lose purchasing power over time because of inflation risk. Most people create a mix of stocks, bonds, and cash in an investment portfolio with the percentages that change over time given changing needs and circumstances. Okay, folks, we're going to stop there and pick up with the other asset classes in the next video. Thanks for watching. Please hit like and subscribe, and remember to tell your friends about us. I appreciate it. See you next time.